What if I told you the money sitting in your bank account isn't really there? Not metaphorically, not philosophically, literally, if everyone tried to withdraw their cash at the same time, the system wouldn't bend, it would collapse. Not in days, in hours. And this isn't a bug, it's the blueprint. Welcome to the hidden design of modern money, a system so normalized, so deeply embedded, that questioning it feels radical. This is the story of fractional banking, the quiet engine behind global debt, inflation, and the illusion of wealth. And once you truly understand it, you'll never look at money the same way again. We live in a world where wealth appears as numbers on a screen, a balance in an app, a notification from your bank. It feels solid, reliable, real. But that feeling is built on trust, not substance. Because if every customer walked into their bank tomorrow demanding their money, the truth would surface instantly. Most of it does not exist. The system survives only because not everyone asks for it at once. That's not conspiracy. That's how it was designed. To understand how we got here, we have to rewind long before apps, cards, and online banking. In medieval Europe, money was physical. Gold, silver, coins you could touch, jewels you could trade. If you were wealthy, your wealth had weight. But carrying gold was dangerous. Thieves, wars, long journeys, so people began storing their valuables with goldsmiths. Craftsmen who already had strong vaults and security. In return, the goldsmith issued a receipt, a written promise that the gold could be reclaimed at any time. At first, these receipts were just storage claims. But then, something changed. People realized they didn't actually need the gold. They could trade the receipt instead. It represented the value just as well. And it was far easier to carry. And that's the moment the trick was born. The goldsmiths noticed something important. Almost nobody came to withdraw their gold at the same time. Out of 100 depositors, maybe 1 or 2 would show up on any given day. Most of the gold just sat there, unused and untouched. So the goldsmiths had an idea. If everyone isn't asking for their gold, why not issue more receipts than gold? If they held 1,000 coins, they might issue 2,000 claims. Those extra receipts could be loaned out with interest. Profit created from gold that didn't exist. As long as people kept trusting the receipts, no one noticed. Money had been created out of thin air. This wasn't a small side hustle. It wasn't clever bookkeeping. It was a revolution. One society accepted paper promises as equal to real money. Creation was no longer limited by reality. Banks emerged, institutionalized goldsmiths, and governments quickly saw the opportunity. In 1694, the Bank of England was founded, not to serve the public, but to solve a government problem. The crown was drowning in war debt. The solution was to borrow money the bank didn't actually have. In return, the government promised interest payments. That debt wasn't repaid with conquered treasure, it was repaid with taxes from ordinary citizens. Sound familiar? It should. It's the same model governments use today. Borrowing from the future and billing the public later. Early American banks followed the same path. They issued paper notes redeemable in gold, but quickly learned they could print more claims than gold. Eventually, reality pushed back. Bank runs, panics, crowds demanding their money, and suddenly, the illusion collapsed. Banks failed overnight. So did governments shut the system down? No. They doubled down. They created central banks. Not to end the illusion, but to protect it. The message was clear. Even if the money isn't there, we'll make sure people believe it is. And that belief kept the system alive. Now, bring this into modern terms. Imagine you deposit $100 into a bank, you assume it's sitting there waiting for you. It isn't. Traditionally, banks were required to keep only a fraction, say 10%. They keep $10. They lend 90. That 90 gets deposited somewhere else. That bank keeps 9.n, lends 80-1, again and again and again. By the end, your original $100 is turned into nearly $1,000 circulating in the economy. But only 10 ever existed as real cash. The rest is debt. Every dollar beyond the first is someone's obligation. And here's the part most people don't know. That explanation is already outdated. In the United States today, reserve requirements are zero. Since March 2020, banks are required to hold nothing against deposits, not a single dollar. So what stops banks from lending infinitely? Not reserves. The real leash is something else. And it's global. Modern banking is constrained by capital and liquidity rules. Under a global framework called Basel, created after repeated crises, especially after 2008. These rules aren't written by voters or parliaments, but by unelected regulators. Meeting in Basel, Switzerland. At the Bank for International Settlements, the central bank of central banks. Here's the simplified version. If a bank wants to issue a risky $100 loan, it may need $8 of its own capital. Riskier assets require more capital. Banks must also hold liquid assets, cash, and government bonds. But notice the shift. Banks don't lend deposits anymore. They create loans first. When you get a mortgage, the bank doesn't move cash from a vault, it types numbers into your account. New money. That money exists because you agreed to repay it. Only after the loan is created does the bank check the rules. That's why over 90% of money today is not cash or central bank money, but bank-created money, born as debt. Every expansion of the money supply depends on borrowing. And every financial crisis is a crisis of confidence. This system produces three unavoidable outcomes. First, inflation. As credit multiplies, each unit of currency loses value. Prices rise, not just from shortages, but from dilution. Second, permanent debt. Interest ensures more debt exists than money to repay it. Someone must always borrow again. Third, concentration of power. Banks earn interest on money they never had. Governments fund wars and bailouts invisibly. Asset owners benefit. Workers fall behind. And the gap keeps growing. When the illusion breaks, the consequences are brutal. 1929, the Great Depression. Banks collapsed by the thousands. Mortgage debt multiplied beyond reality. When default spread, the system nearly imploded. Each time the response was the same. Trillions injected. The illusion patched. The system preserved. Because without it, modern economies stop. Globally, the pattern is the same. In the United States, reserves are gone. In Europe, the UK, Canada, and Australia, symbolic at best. Emerging economies still use reserves. China and India and Brazil, but Basel rules dominate everywhere. Money creation is limited by confidence. Here's the uncomfortable truth. The system cannot survive if everyone becomes debt-free. If all loans were repaid tomorrow, the money supply would collapse. Banks would stop lending. Economies would freeze. You are the fuel, and you are the collateral. So understand this clearly. Money is not wealth. Wealth is land, skills, resources, knowledge, and independence. Debt is not neutral. Inflation is not accidental. This system rewards asset holders and punishes savers. The lesson isn't fear, it's awareness. History doesn't repeat. But it rhymes. Goldsmiths. Panics. 2008. Different era. Same mechanism. And remember this, the system runs on confidence. And confidence is fragile. So the next time you check your balance, understand what you're really seeing. A promise. A belief. A digit backed by debt. Understand the game, or stay trapped inside it. If this changed the way you see money, subscribe. History has answers. And this story isn't over.